Dear students, this lecture is for 5th Sem BCom. The subject is Accounting for Managerial Decision. Today's topic is Inflation Accounting and subtopic is Lease Accounting, Unit 5, Session 50. Students, the learning objective of this session is to understand the concept of lease financing, its features, types, merits and demerits. Session outcome is students will be able to know that leasing is a new source of financing capital assets. Firms are required to go for massive expansions, diversification and modernization. Essentially, such projects involve a huge amount of investment. High rate of inflation, severe cost escalation, heavy taxation and meager internal resources forced many companies to look for alternative means of financing the projects. Leasing has emerged as a new source of financing capital assets. Let us have a look on definition of leasing. According to Dictionary of Business and Management, lease is a form of contract transferring the use or occupancy of land, space, structure or equipment in consideration of payment, usually in the form of a rent. Let us try to understand the meaning of leasing. A lease is a contract between lessor and lessee for the hire of a specific asset selected from a manufacturer or vendor of such asset by the lessee. The lessor retains the ownership of the asset. The lessee has a possession and use of the asset on the payment of specified retain over the period. Let us have a look on features of leasing. The lease finance is a contract. The parties to contract are lessor and lessee. Equipment are bought by lessor at the request of lessee. The lease contract specifies the period of contract. The lessee uses these equipments. The lessee in consideration pays the lease rentals to the lessor. The lessor is the owner of the assets and is entitled to the benefit of depreciation and other allied benefits. The lessee claims the rentals as expenses chargeable to his income. Let us try to understand the types of lease. The first one among the type of lease is finance lease. The finance lease is a lease. The lessee selects the equipment, settles the price and terms of sales and arranges with the leasing company to buy it. Under a financial lease, the rate of lease would be fixed based on the kind of lease, the period of lease, periodicity of rent payment and the rate of depreciation and other tax benefits available. The second one is operating lease. In operating lease, the contractual period between lessor and lessee is less than the fully expected economic life of equipment. This means the lease is for a limited periods, maybe a month, 6 months, a year or few years. The lease is terminable by giving stipulated notice as per the agreement. This operating lease is suitable for computers, copy machines and other office equipments which are sensitive to obsolescence. The third one is leveraged lease. The leverage lease agreement involves three parties: the lessee, the lessor, and the lender. The lessor acquires the assets as per the terms of lease agreement but finances only a part of the total investment, say 20% to 50%. The balance is provided by a person or a group of persons in the form of loan to the lessor. The fourth one is sale and lease back. Under this type of lease, a firm which has an assets sell it to the leasing company and get it back on lease. The asset is generally sold at its market value. The firm receives the sale price in cash and gets the right to use the asset during the lease period. The firm makes periodical rental payment to the lessor. The title to the asset vests with the lessor. The fifth is the cross-border lease. The cross-border lease is an international leasing and is known as transnational leasing. The lessor may be of one country and the lessee may be of another country. To illustrate, if a leasing company in a USA makes available an Airbuses on lease to Air India, there would be a cross-border lease. Let us try to understand the advantages of leasing. The first advantage is it permits alternative use of funds. Leasing arrangements provides firm with the use and control over asset without incurring huge capital expenditure. The firm is required only to make periodical rental payments. The next advantage is faster and cheaper credit. The lease permits the firms to acquire new equipment without going through normal scrutiny procedure. Hence, acquisition of asset under leasing arrangement is cheap and fast than any other source of finance. The next advantage is flexibility. Lease rentals can be structured to match the lessee's cash flows. It can be skipped during the months when the cash flows are expected to be low. The next advantage is facilitates additional borrowing. Leasing may increase long-term ability to acquire funds. The lessee can utilize more funds for working capital needs. The next advantage is protection against obsolescence. A firm can avoid risk of obsolescence by entering into operating lease agreement. This highly useful in respect of assets that become obsolete at faster rate. The next advantage of leasing is no restrictive covenants. Under leasing, the restrictive covenants such as debt equity ratio, declaration of dividend, etc., which are usually imposed under debenture or loan agreement, are absolutely absent in lease agreement. The next advantage is 100% financing. Lease financing enables a firm to acquire the use of asset without having to make down payment. So, 100% financing is assured to the lessee. The last advantage of leasing is boon to small firms. It is a boon to small firms and technocrats who are able to make promoters contribution as required by financial institutions. Let us have a look towards disadvantages of leasing. Disadvantages of leasing are, the first one is not suitable mode of finance. Lease is not a suitable mode of project finance. This is because rental are payable soon after leasing into lease agreement, entering into lease agreement, while new project cash generation may start only after long gestation period. The second disadvantage is subsidy may not be available. Certain tax benefits or incentives such as subsidy will not be available on leased equipment. The next disadvantage is loses the advantages of potential capital gain. The value of real assets such as land and building may increase during lease period. In such case, the lessee loses the advantage of potential capital gain. The next disadvantage is high cost. The cost of financing is generally higher than the debt financing. The next disadvantage is not able to pay rentals. If the lessee is not able to pay the rentals regularly, the lessor would suffer loss, particularly when the asset is sophisticated one and less liquid. The last disadvantage of leasing are not entitled to any protection. The lessee by himself is not entitled to any protection in case the supplier commits breach of warranties in respect of leased assets. Thank you.